We want to talk about the money, of course, but before that, we have to spend a moment on Thousand Oaks. I know the Walt Disney Company and you personally are always concerned about the communities in which you act, and certainly Thousand Oaks really is part of your community. Are your colleagues safe?
Yes, as far as I know, our colleagues are safe, but because this happened in our own backyard, a lot of people who were there were known to people who work for our company or were related to people who work for our company, and some have had some really bad news. It's been a very, very difficult morning. Yeah, indeed. It's a tragedy, and it keeps getting repeated across the country time and time again. Let's go back, though, to the earnings. It has been a big news. Congratulations. You not only beat expectations, but compared to last year, both in earnings per share and revenue, was terrific. How much of that was really the studio and the theme parks? Well, studio and the theme parks both had record years and record quarters, so clearly they were a big part of the success that we had in the fourth quarter. That's actually true for the year as well, but we also had some good results at our media networks, particularly in broadcasting. So it ended up being a great quarter for the company, pretty much across the board. So it's nice to have some tailwind as you go into this very big merger. Where are you on the 21st Century Fox? Give me a sense of the timing. When do you expect it to close? Sure. We're still going through the regulatory process. A lot of progress has been made there. We announced just a couple of days ago that we gained approval in the EU. That was a big deal for us. There are still some markets or some countries actually, that we're waiting for approval on, and we're in the middle of that process. Back in June, we said that it could take as long as 12 months to close, and we're now increasingly more optimistic that it will occur meaningfully before that, but we're not saying specifically when. As we wait for regulatory approval, we've started to really focus on integration. We've made some announcements in that regard, particularly at Television Group and at the studio. But when we talk about integration, we're talking mostly about integration planning, not implementation. So even though we've made some announcements about people and structure, obviously nothing can be put into place or operated against until the deal's closed. But knowing you as I do, we feel good. We've gotten a lot done. Go ahead, sorry. No, I was just going to say, you're a planner. I know that. I worked for you. So you've thought this through, even though you're not implementing yet. As you look forward, how are you going to justify that price? Because it's a pretty healthy multiple you're paying for those assets. How much of that's cost savings? How much revenue growth? Well, these are great assets that we're buying. They're assets that not only are doing well today, but we believe that can do incredibly well in the combined entity, particularly as we move more and more in the direction of direct-to-consumer businesses, where intellectual property will become critical and brands will become critical, and as well as the talent that is required to make the kind of product or to see that this kind of product that we're going to need is made. All very, very important. So there's substantial justification for the price when it comes to strategy, when it comes to revenue growth, and when it comes to bottom line growth. And there are opportunities for cost savings, as we said when we made the deal, because of the overlap in some of our businesses. But this is largely going to be driven by the combined entity having the ability to operate even more successfully going forward. And when you think about all the transformation that's going on in the media landscape, having these kind of assets, this kind of scale, these brands and the people is vital to the success of this company and its ability to grow long term. Might we also see some further realignment of assets? You already, of course, are disposing of the regional sports networks. That's required of the regulators. But could we see some other realignment, for example, in basic cable? For example, AETN for Hulu. We're actually getting rid of AETN, disposing of it, and actually buying the rest of Hulu that you won't own after the merger. Well, I'm not going to say anything about AETN. You're talking about A&E and Lifetime, I assume. You're a little garbled. Is that what you were? Yeah, it's AETN with Lifetime. Yeah, that's right. Oh, I see. Oh, AETN. Thank you very much. Yeah. No, we're not going to comment at all about that. We're not currently planning to divest any other assets except the RSNs, as we said, and we've also said that if after we acquire Fox's stake, we'll have 60% of Hulu. If the other owners, Comcast and AT&T, Time Warner, are interested in divesting their shares, we'd be more than willing to step up and buy their pieces. And last question, Bob, because I know you have to run. Is this it, at least for Bob Iger and his tenure? That is to say, will this give you the size and scope that you need to move into the direct-to-consumer business that you want? Unequivocally, it will, yes. Very excited about that. It's one of the reasons why we did this deal in the first place. It happened after we had announced our strategy to go into the direct-to-consumer business, and this will be considerable in terms of its impact on our ability to succeed in that space and with that venture.